So let's take a look and see how students and I capitalized on a 5R winning position yesterday on gold. So after NFP's corrective move, so this move to the upside that was induced on Friday's NFP data, we can clearly see that the price was accumulating in this sideways range after being extremely oversold and overextended to the downside. Price started to accumulate in this range, then we saw a sweep of the lows exactly here, taking out all the sell side liquidity, followed by a bullish market structure shift, in other words, a higher high. After the higher high, as you would expect, price then reached for the buy side liquidity residing above all of these highs. So after the Friday bullish move, and after the tensions, the geopolitical tensions increased over the weekend, I had a bullish bias based on the fact that investors should and could possibly start to turn to safe haven assets. So as we approach the market open, what I could identify yesterday is price started to consolidate in this wedge. Now, we speak about these wedges over and over again. It is a textbook inducement pattern. What we can also identify, if you look to the left, we had this area of fair value. From that wick high to that wick low, there was this level of imbalance in the market. And as you can see, yesterday on the London session open, we never tapped into this area of fair value. We can see price pushed to the upside quite aggressively, got rejected, and started to form the lower highs. So the fact that the market started to form the lower highs and the fact that the overall trend was most definitely bearish, we just saw a corrective move which was induced on Friday's NFP data. This gave me the understanding that retail traders are going to be looking for shorts, and you want to be aligning yourself the opposite direction of the masses, because that is where the most amount of stop losses reside. So as soon as we started to see these lower highs, this was an indication to me that traders, retail traders, were going to be looking to take this short to capitalize on a corrective move, or sorry, a continuation move. So this creates liquidity above that high. Okay, buy side liquidity was created above that high. What we also have above that high, as I just mentioned, is this 15-minute area of fair value to the left, giving us two confluences to expect price to take out that high. Then what we can identify is price started to consolidate in the form of this wedge. Now, as I said, wedges are textbook inducement patterns. What happens is traders, retail traders, are taught to believe that this wedge formation is a continuation pattern. So traders are anticipating a bullish breakout of this wedge. Now, what they start to do is they start to buy this ascending trend line. Okay, there is always two sides of every story, two sides of every argument. In other words, there is always buyers and sellers that perceive the market information in different ways. Now, what we can identify, there definitely was sellers that were pushing this lower, and there obviously were buyers that were buying this ascending trend line. Now, the buyers that were buying this ascending trend line looking to capitalize on a breakout move, their stop losses would have been exactly below the Asia session low. So we simply waited for price to break out of this wedge. If price broke out of the wedge to the upside, then we would have looked for the shorts. But the fact that the market broke the wedge to the downside, it took out the sell side liquidity below this ascending trend line. Not only that, but we swept the low of the Asian session. This was all indications to me that price would then look to attack, look to draw on the buy side liquidity above this high, and look to fill the area of fair value that I've already identified. So we simply waited for price to break out of the wedge. Once price broke out of the wedge and swept the stops below the Asia session low, we dropped to the 1 minute time frame. Now, what we can identify from a 1 minute perspective, since sweeping the Asia session low, exactly here, price made a 1 minute market structure shift. Now, what do I mean by that? Here we had the previous lower low. Then from exactly this lower high, price made a sweep of the lower low. Okay, so we got a sweep of the low right here, and then from the lower high that created the sweep, price then broke above it and formed the higher high. This is known as a bullish market structure shift, and this was my entry confirmation to indicate that the move to the downside was a potential fake out to induce traders short and stop hunt the early longs. I entered on the retest of the 1 minute demand order block which created the market structure shift exactly here. I took a buy limit as soon as price tapped into that zone. My target was the buy side liquidity residing above Sunday evening's New York session high. Obviously, with the anticipation that price could easily fill in the fair value gap above us, I had my stop loss well placed below the low. And as you can see, this played out beautifully. If we just go back to the 5-minute time frame, you can see price hit my upside target all inside of the New York session. Okay, so we hit 5R target inside of one session, and I did hold a small runner, which I'm still holding now, which is currently floating at around 7R, 8R profit. Okay, so my stop was a little bit bigger, but as you can see, beautiful move to the upside and a textbook example of how you can use a wedge as an inducement to anticipate where retail stops are. Retail stops are the key to profitability in intraday trading. The market will always move where the most amount of liquidity is, and the wedge is one of the best ways we can identify where the liquidity may be in the market. Hope you enjoyed the video, guys. Don't forget to subscribe to our free Telegram channel for more live setups, education, analysis, and much more. Take care. See you soon.